the panel, which is a hot topic, right? We've heard every panel to date, including Sam, talk about office. In passing sometimes a little in depth, but mostly in passing. We have a panel just to talk about office, and it really requires more than 30 minutes. We could talk for hours about this, but we have 30 minutes. So we're going to talk fast. I'm a New York lawyer at the end of the day. And so buckle up. We're going to start. But a little housekeeping. I like each of my panelists to take a few sentences to tell you about themselves. Not so much about anything other than why the perspective that they're talking about. You can Google them, and they all have LinkedIn's and Google pages. But to talk a little bit about what they do, that gives you a little perspective of why it is that they're talking and why they're on the panel. And also, when I ask questions, I'm going to have the same question asked of each one of the answer, because unlike some of the other panels, I think the perspective that they bring is a little different. I think on this panel, we have those who are focused on the tenant side, including myself. We have 30 offices, so we're actually users of space around the country. But then we also have a couple of gentlemen who are focused on the landlord side. So those perspectives are different. Unlike the last panel, which were all made up of lenders, we've got a perspective here, and you need to understand the perspective. So let Gabe introduce himself, and then Rick, and then Paul.
Cool, thank you. Hey everybody, nice to be here. My name is Gabe Marins. I am an executive managing director at Savills. We're a tenant rep, primarily office leasing firm. I've spent 15 years, I was an intern actually at the company, and we strategize and help companies figure out their occupancy strategy. So it has been a fun couple of years.
Thank you for having me, and thank you for inviting me, Chester. My name is Rick Reckney. I'm Director of Asset Management for Time Equities. Time Equities has been around since 1966. I've been there since '87, so almost the full duration of the company's history. We have a fairly diverse portfolio. We are a landlord, not a tenant. We have office properties throughout the United States, Canada, and in several countries in Europe, so our perspective is pretty broad. Of our total portfolio of about 39 million feet of space, about 55% of it is office.
Paul Houston. I'm a partner at Island Capital. I'm the Chief Investment Officer of our Recovery Fund series, which is a series of 4 value-add real estate private equity vehicles. We're probably about 40% invested in office, maybe 35 to 40%, which is about 8 million square feet of office throughout the country.
Great. So that's the perspective that I think the panelists bring to the table. We're talking about the current state and the future state of commercial office occupancy. By all accounts, it's starting to tick up. I don't know what we did before card swipes, but with the card swipe, the data from CBRE and Cushman and various independent groups, we see occupancy slowly rising, even in places where it was very weak, San Francisco, New York, among others. But I don't think anyone in the space think we're going to ever go back to the pre-pandemic levels. And so with this new world that we're in, which is still kind of in flux, I want to ask each one of you where you see the valuations are at on these things in the capital markets, both on debt and equity. What do you see cap rates doing in this on the sell and buy side? What do you see LTVs on the lending side? And that's a compound question. And is that driven also by CBD versus suburban, by flex space versus life science space, by office in mass transit locations and driving locations? They tend to be different. So maybe I'll start off at the end and try Paul first.
And I think my guess is this is a New York-centric panel. A lot of folks probably sit here in New York, and the office market in New York is terrible, right? And the office market, where most institutional equity and debt sits, is pretty bad. So if you look at New York or DC or Boston or San Francisco or LA, those markets are probably the slowest to have come back from COVID. However, in a number of Sunbelt markets where we own assets, we've probably done more leasing in the last 2.5 years since COVID than we did in the 2.5 years prior to COVID. So I think it's very difficult to generalize about office, other than institutional capital, both on the debt and the equity side, right now hates it. But a couple of years ago, institutional capital hated retail. And now there's certain retail that is looked at as a loser and certain retail that's looked at as a winner. And I think you're going to see that in office as well, that it's certainly a case of the haves and have-nots, and there are assets that are economically obsolete and probably will not prosper post-COVID no matter what happens. However, there are other assets where I think the opposite is true. And I think we see a tremendous amount of opportunity in places like Austin and Dallas and Palm Beach County and Dade County, Broward County, Jacksonville, Tampa, Nashville, Denver, and we don't see too terribly much opportunity in a lot of the major gateway markets. If you're looking for a loan right now on office, it's virtually impossible. There's almost no such thing as value-add debt available for office in today's market. There's maybe a little bit of core and core plus type debt available, but opportunistic and value-add, it's really few and far between. So I think we're at a point where I think prices are going to be, there'll be some pretty attractive buys, but there'll also, by the same token, there'll be some things that are spectacular failures.
Yeah, before we get to Rick, about 2/3 of those locations you mentioned are in Texas and in Florida, and it bears out in our firm. Our Texas offices and Florida offices as if COVID never happened. They're in 100% all the time, and in fact, as we as a firm discuss, work to back to the office policies, the Texas offices and the Florida offices, we should be exempt. We don't need that because we're always here. So the geographic does make a big difference. Rick?
Geography makes a huge difference. Our portfolio in the Netherlands, mostly B properties, is pretty close to occupancy levels pre-COVID versus today. However, as you could imagine in other markets, it's not the case. In fact, in general, it's probably 30 to 40%, if not in some cases 50% below what pre-COVID levels were. Occupancy, not leased. Important difference to make there. We tend to be a contrarian, so for us, we like these opportunities, especially when the debt markets leave asset classes like office space. They have good luck trying to find debt unless it's recourse. We have closed a few loans. We have bought a few office assets, but they were discounted by over 50% of what their prices were pre-COVID. For us, that's a motivating factor, and we have been successful in repositioning buildings by doing some of the things that there's another discussion that's going to come later that you'll hear about that we do in these buildings to make them better assets, better investments. And for us, that's a play that we'll continue to follow, but I don't think the office market has bottomed out yet. I think as interest rates continue to rise, and they will rise, and the story unfolds about how that's going to impact the economy, that the office situation will worsen, and then for us, there'll be even more opportunities to buy office assets, and we'll be there to buy them.
All right, so tenant rep perspective time. So in an ideal world, we're on the opposite side of the table where when things are really bad, it's really good for the tenant. And yet I'm in this unique position where I feel like I'm talking up the office market. So I'm going to talk a little bit about New York. We talk about how crappy the market is, and we forget that from a office leasing transaction volume standpoint, we surpassed 2019 numbers in New York City. Okay? So why is availability 2x what it was? It's because over the last 15 years, we've seen 30 million square feet of new development. New York's a 450, 500 million square foot market, Manhattan alone. San Francisco is 100 million square feet. We're also on an island. San Francisco is not on an island. And so there are huge geographic differences, but it's not just as it relates to return to office. It also has a lot to do with how offices are being used. The other thing that I really want to make that Chester was talking about is this Castle system score about occupancy. Now, CB, Cushman, Savills, we all publish our data. All the REITs publish their data, and nothing can agree with each other. And so I think we should be taking a step back from that and stop grading office space by occupancy. Because what other asset class do we grade by occupancy? Certainly not retail, not residential, not industrial, not multifamily. And so when we think about it from that perspective, why are we doing it that way? And so I think that that's one of the lasting elements of the pandemic. I think we have to move away from that. Now, I'll leave it to the lenders to figure out how they want to think through all of that. But from that perspective, I think it's really key. The other thing, and I'll finish on this, is yes, the world has changed. And yes, there are people back to the office in our Dallas and Houston office. That's at odds with what we're seeing in New York. However, there's still a lot more flexibility around when you should not be in the office and Fridays. I'm not saying 3-day weekends, but there are a lot of 3-day weekends, and I see that all over the place. And so we have to acknowledge that the offices are going to be used differently. We have to adjust how we're gauging efficiency in those offices. And then we also have to acknowledge that there is this flight to quality. Leasing is happening, but if you own B-class space in a mid-block building in New York City, that's commodity, and you have to differentiate, and the only way to do that in this market is by pricing at the lowest.
Well, let's stay with you, Gabe, because I think the next question really is in your wheelhouse, which is, as you see leasing being done, you talked about leasing volume this year being high in 2019 in New York. When you see new leases or even renewals, and no one's renewing really on the terms of the renewal, they're renewing on different terms, so it counts as a new lease in my view. So when you're seeing new leases, what are the differences you're seeing pre-COVID? Are terms shorter? Are there COVID clauses? Or are there, hoteling provision put in? Are they taking less space, more term? What are the trends in the new leasing that you're seeing?
Yes, is the answer. So it really depends, which is probably the way 90% of these answers have been answered. Where to start? There's definitely, so one of the vestiges of WeWork is this acknowledgement that landlords need to offer more flexible terms. And so you've seen a lot of that flex operation get pulled in-house from a lot of the major landlords. Generally, I advise against that. You really need scale. It's a different business line. And so you should really partner with people, which is why all the co-working companies are now primarily pursuing management agreements because there's now a market for that. Think Industrious. So that has lent itself to shorter lease terms. That obviously interferes with lenders. We're doing a lot of renewals. The single biggest important thing from a tenant's perspective right now is how expensive it is to build. And so when you think about a renewal, you might not be able to reduce your spend, although we're getting that too. But you are going to have a full all-in cost that's much lower than if you were to move and have to build out all the space. And so cost to build is the most important thing, and that will flow to what companies decide to do. A lot of them are shrinking, but a lot of them are moving into more expensive space with a smaller footprint.
Thank you. Rick?
So I think COVID is giving us an advantage in one respect, and that is that it has taken away the time and the luxury of time that many tenants have to plan out their office needs. And this actually works to our advantage in that case, if you're ready to move fast and can move fast. I agree that the cost of the build-outs is a hindering factor in any negotiation with a tenant. It's gone up to levels where you are seeing net effective rents at levels which don't make any sense unless the lease term is long. So you get into these negotiations over lease term versus tenant improvement allowance, and where you used to automatically get 10 to 12 years for larger tenant improvement allowances, you're now seeing 7 to 8 years, which only compresses your net effective rents even more. And that also then ties back into the valuation of these buildings, where we already spoke, they've declined, but it's a direct result of the net effective rents going down. But in general, we've also seen new types or attempts to get new types of lease clauses in the leases, the COVID clause. We have had, I think, every single lawyer who's given us markups of a lease try to put that clause in, but we push back and are successful in not granting.
Everyone, right?
Every single one.
And we've never gotten it.
Yeah. Every single one is an attempt, but we push back.
But we buried it in our clauses. We call it healthy buildings.
Yeah, and so we have healthy building clauses, have had healthy building clauses in our leases, even pre-COVID, where we have sustainable goals, and we implement those sustainable goals, which are pretty standard for us. And that goes back to what's another question later about amenities. We view sustainability to be an amenity.
Paul?
I mean, I would agree that maybe that the answer to all of these questions is it depends, and that's maybe the answer to most questions. But I would say, generally speaking, when we look at our portfolio, leasing activity continues to be incredibly robust in the 1,500 to 15,000 square foot, right? So, and those tenants tend to be local, they tend to be smaller, and what drives those tenants is very different from what drives national tenants that maybe are making the leasing decision in New York or Chicago or LA and San Francisco. And the guys who have 50,000 or 100,000, 200,000 foot, requirements, that's very, very quiet in most of the markets that we're in. Pre-built, you want to lease something in most markets, you need to have a pre-built suite, right? So I think that's what you were saying just a minute ago. The time for tenants making the decision has compressed quite substantially. So if you have spec suites and you have lease-ready space in most markets, and it's 1,500 to 15,000 feet, you'll be able to lease it. And one of the things I think that's different today, when we used to do spec suites, most spec suites we did were maybe 1,500 to 3,500 or 4,500 square feet. 4,500 was a large spec suite. Today, you can do spec suites that are 10,000 feet, 12,500 feet, and then maybe move a wall for a conference room or maybe create another office. But I think tenants want space just in time, and that I think is very, very different from what it was. I think there's also a bit of the battle of the amenities. So you want to lease a suburban office space, you need covered parking, you need a conference facility. It's nice if you have a gym with showers, whether anyone uses it. It's kind of like the gym at an apartment complex. It's nice on the tour. Maybe not that many people use it, but it is important, I think, in the overall leasability. And virtually every project that we have has some, brand new shiny amenity attached to it, and that helps.
Yeah, we're going to come back to amenities, generalized. By the way, the answer to the question about it depends is exactly what happened when I asked my wife to marry me. So I'm familiar with that
Chester,
answer.
what did it depend on?
We don't have enough time. So Rick is dying to talk about amenities. I can see him frosting to talk about amenities, but I want to generalize the question more than amenities, which is what are landlords doing to attract and keep tenants? And it's more than amenities, right? We can talk about concessions, we can talk about TI. There are a host of weapons at the disposal of a landlord on amenities. I mean, you don't have to go far on amenities. You just walk through one Vanderbilt. The other day, I was walking, I had a meeting at One Penn Plaza, which has been renamed Penn One, which, by the way, all New York buildings have these names. I don't understand it, but it's now Penn One. And talk about amenities. But at the end of the day, is that what it takes, or are there other things that landlords have to provide to keep tenants and to attract tenants? Rick?
So this is really not an amenity, but if you think about it, it is. One thing that back in the financial crisis of the late 80s and early 90s that became a dominant theme among tenant rep brokers is the credibility, the financial credibility of the landlord. And they wanted absolute certainty that you could pay their commission, that you could pay their tenant improvement allowance, and then negotiated lease clauses that if you didn't, what would happen? Well, we're back to those days, that now you're seeing tenant rep attorneys, tenant rep brokers, wanting assurances that when you come up for refi that you're not going to be underwater and that the bank isn't going to repossess the building. So the tenants are wanting the amenity of a financially strong landlord. And the first sign of that, absent seeing the financial statement, is seeing what that landlord is doing in its building to reinvest in the building, to make it something that's relevant in today's market, that is going to allow the tenant to keep and attract their workers, which is their largest expense and probably their most critical expense. So any amenity that can allow that attraction and retention is very important to those tenants. One of the chief things that fall into that category is the health of the building and being able to have systems in the building that have proper fresh air, that have proper filtered air, that have outdoor spaces, or that you can create outdoor spaces in. It's very important in today's market. Other things you can do that we've done, you know them all, gyms. We also have a unique program that we call Art in Buildings, where we literally go and buy art and take it on a rotating basis or a permanent basis and place it throughout the buildings. It becomes a conversation piece for people in the buildings. And then we constantly survey the tenants in our building, asking them what more amenities and what different types of amenities that they want. And where we think it makes sense, we follow up and actually implement those things as suggested to us by our tenants.
Gabe, when your clients come to you, and what is compare A to A, building to building, as much as you can equalize that, what tips the scale in terms of what landlord's willing to do?
All right, so let's talk a little bit about amenities. So there's nothing that's going to be new to you. I just want to make the point that geographically there are some differences. For instance, in Chicago, it's starting stakes for you to have a gym in the building. New York, it's not the case. I think a lot of that has to do with the mixture of residential and office in New York, where you do have a lot of gyms that are not house and office buildings, but that's just conjecture. So I want to note that. I think the sustainability point is really, really important. We do work nationally. We also do work globally. And there seems to be this trend where things start in the east and move their way to the west and then land on our shores last. And this seems to be the sustainability question. We were getting this from our clients first in Australia about 5-6 years ago, and Europe has been very focused on sustainability and ESG grades and WellFit. I forget all the different wellness grades. And now in New York, it is governing almost anything with companies of a certain size. Now, some of it is genuine. Some of it is because of shareholders, and some of it is because of their internal ESG groups, but it is 100% happening. So most of the amenities are BS. They're there for the tour and not much else. Conference facilities are really important, and probably the most important out of the amenities. Interestingly enough, though, for the larger tenants, we're talking about 50,000+ square feet or more. Some companies really don't want their employees to leave their space. And so if there is a building conference center or a gym or outdoor space, they really don't want them congregating with outside of the space. And so often you'll see those tenants take more space so that they could build that functionality within their space. That's not most companies. It is more expensive, but that is certainly a trend.
Paul, I think you touched upon some amenities, but what else in that landlord incentive area can you talk about?
Leasing commission bonuses, right?
I'm just going to say, anytime you see something advertised with a commission bonus, it's a signal. You know, it has to be communicated like on stage, on panel, quietly.
I mean, that's in a lot of markets. That's a big deal, right? You know, for tenants of any size, today, it's almost a prerequisite.
I agree with that.
I have a question. Is that about differentiation? Because I'd like to think that no broker is going to show space specifically because there's a higher fee. I'd like to think.
I don't. Yeah, I think it's ubiquitous in the market, but I think that for any good tenant rep broker that's trying to get the best deal for the tenant, he's gonna negotiate actively for the tenant. But he's also going to be thinking if there's a way for him to share in the good fortune, all the better.
I'd like to make one clarification of that. Normally, the broker, who's the procuring broker for the deal, splits their commission with the house. So if you can structure the bonus so that it goes directly to the broker so they don't have to split it with the house, that puts you heads up over everybody else.
You're not worrying where he's violating his employment agreement. But okay.
No comment.
That's a lawyer talking.
But there, amenities in outdoor space in many markets is incredibly important.
Yeah.
Right? And it's big in Florida. It's big in the Carolinas. It's big in Nashville, in Texas. It's very important. Conference facility is really a must. And then I think some buildings, differentiate themselves on, small things. Like if you have a building in Denver and your parking garage isn't attached to your building and you have to walk outside, that's a problem.
Get it. So this was not a planned question, but I think there was a lot of talk earlier today about repositioning office. And this may be not something that you necessarily will focus on, but certainly for Rick and Paul. Sam earlier in the day talked about the fact that that's a fallacy, that office buildings tend not to be deep floor plates for various reasons. Have you all, Rick and Paul, thought about what you might do? Have you considered any of those types of projects on some of the buildings that are not trending well?
So the trend right now is for tenants to move up from Cs to Bs, Bs to As. So the theory there is that the Cs are going to be left holding the bag and become largely vacant. Over the course of our history, we've actually taken many of those C buildings and converted them to other uses successfully. And I was telling Chester, we had our company conference, and this similar question was asked last 2 weeks ago. And it's going to be an asset class that we will target to go and find C buildings that are underwater and look at opportunities to convert them to other uses and just repeat what we've done previously.
I'm going to go back to what you said at the beginning, is it depends. And I think generally speaking, Sam Zell is right that there are a lot of office buildings do not lay out well for residential space. Just the way they're developed. It's not all of them, but a lot of them don't. I mean, I was in 1 Wall Street a couple of weeks ago, which is the Harry Mackler development downtown. I guess, what was it? Was that the Irving Trust building back in the day? I think it was. The apartments were way better laid out than I expected. Like, I expected it to be horrible, and it wasn't. So I think sometimes you can, oftentimes you can't, but also sometimes if you can doesn't mean you should, because it can be hugely expensive depending on what you're dealing with.
Yeah, and there's an sort of interesting thing about rehabbing office, which is there are a decent amount of government grants and credits available generally to do a lot of that stuff. And so that can make something pencil that otherwise wouldn't. We have 2.5 minutes. This is such a hot topic. Can I ask anyone in the room who has a question or two?
Yeah, I'm just curious about the WeWork model. How does that come into play in this new environment? Can you talk a little bit about these short-term lease tenants and how it's affecting the world?
I wouldn't call our model to be a WeWork model, but we've had many office buildings, both in the city of New York, outside the city of New York, where we deliberately create an incubator within the building, where you create a whole bunch of small spaces, some medium-sized spaces, some bigger spaces, and then you have an aggressive approach to allowing expansion and contraction of those tenants within the building to other spaces, and where we encourage it. We never went for WeWorks for many reasons. First, they never had financial credibility in our view. And where we did see them in buildings, we felt that they destroyed the buildings, and it made difficulty in leasing the rest of the space that was available in the building. But we would still do, and we are doing the sort of incubator effect within the buildings that's quasi-WeWork.
Yeah, I just want to say there was a lot of WeWork stock bumped 20% yesterday. There's a lot of chatter about WeWork being the future. They're also simultaneously handing back leases all over the country. And so they're trying to right size on this. They overextended, and all of them are pursuing management agreements. They're trying to lessen their exposure across the board. Tishman, Durst, Silverstein, Vornado, they all have in-house flexible, Tishman, flexible platforms. I think some of those are going to fall away, and they're going to be replaced by the Convenes and the Industriouses of the world. It's a really critical point, but I think most landlords should not be in that game. It's a completely different service deliverable.
But one thing also to keep in mind, and even that is changing a little bit. I mean, I don't think we have WeWork in the portfolio, maybe in one building. We have Regus in a couple of buildings. Generally what's happening, or our experience of what's happening today, is the built-out offices in those spaces, 100% occupied. But the open floor plan space where you're just renting a desk is crickets. Like, people don't want that. And a lot of the space was built out that way, 5-6 years ago. And a lot of that space is going to need to be reconfigured in order really to be leasable, ultimately.
Yeah, sorry guys, I'm like hogging the airwaves here. Another trend that I just want to point out, I'm seeing in-office demand the strongest with companies smaller than 50 people. And a lot of them are going to these enclosed offices in WeWorks or pre-built spaces in buildings where landlords could offer 2-3-year terms.
I think we're out of time. You have one more? He looks very desperate to ask a question.
I'm just curious, you mentioned you guys spec out some 10, 15,000 square foot spaces. Is
I would say that in a lot of markets, kind of the interior office, cube farm, open is not preferable. That in a lot of the markets, what you continue to have perimeter offices, but what you need to do is you need to make the walls glass. Or your inserts need to be like 4 feet so that there's significant, light and air in the interior space. But I think most tenants who are looking for, 7,500, 10,000 feet still want a majority of perimeter office.
Great. Thank you. Thank you, Kat.